Today, we're jumping right into the fast-paced, high-stakes world of international business. You know, it's a world where a fantastic deal can turn into a total nightmare in seconds, all because the value of money itself is constantly changing.
So that really is the million-dollar question, isn't it? How on earth do you manage a massive deal when the very thing you're dealing in, money, refuses to sit still? It's like trying to land a plane on a runway that's moving all over the place. That's the puzzle we're going to solve today.
The heart of the problem, the real core challenge, is just that. Exchange rates are always in motion. And these aren't just tiny little wiggles. We're talking about massive swings governed by complex accounting rules that can introduce huge financial risks. A sure thing one day can become a catastrophic loss the next.
All right, so let's start at the beginning. Section 1, recording the initial deal. This is the starting line. Before a single dollar or pound or euro changes hands, a number has to get put on the books. But which number? And in what currency?
First up, we've got to understand what a company's functional currency is. Just think of it as its home currency. It's the money it thinks in. If an Australian company is making sales and paying its staff mostly in Aussie dollars, well, that's its functional currency. It's the language of its day-to-day operations. But then there's the presentation currency. This is totally different. This is the currency for the big, glossy reports you send to shareholders. Imagine a giant multinational company. They might have operations all over the world, each with its own functional currency. But at the end of the year, they've got to wrap it all up and present it in one single currency, like US dollars, so everyone's on the same page.
And that brings us to the golden rule of all this. Whenever you make a deal in a foreign currency, you have to record it right away in your functional currency. And you have to use what's called the spot rate. That's just the exchange rate for that specific day at that specific moment. That transaction is now locked in on your books at that value.
Okay, but here's where the drama starts. Section 2, the waiting game. Because, most businesses don't get paid the second they make a deal. There's a gap. It could be days, weeks, even months. And that gap, that waiting game, is where all the risk is hiding. So let's look at a classic example. We've got an Australian company, and on June 1st, it buys 200,000 British pounds worth of stuff from a supplier in the UK. And here's the key phrase, on credit. That means payment is coming later. Now watch what happens. On June 1st, one Australian dollar gets you half a British pound. Pretty simple. But fast forward to the end of the month, June 30th. Whoa, the Aussie dollar got stronger. Now that same $1 buys you 0.55 pounds. So, back on June 1st, following that golden rule, the company records its debt. They owe 200,000 pounds. At the spot rate that day, that translates perfectly to 400,000 Australian dollars. That's the number on their books. But now look, by June 30th, just because the currency market shifted, that same 200,000 pound debt is suddenly only worth 363,636 Australian dollars. The company still owes 200,000 pounds, but what that means in their home currency has changed a lot. And that difference, my friends, is called a foreign exchange gain. I mean, think about that. The company literally did nothing, and its debt just shrank. It's like the market gave them free money. Now, here's the really wild part. That gain of over $36,000 isn't just a fun fact. Accounting rules say that company has to report that as profit in its financial statements for that period, even though the bill hasn't even been paid yet. But of course, it's not always that simple. There are always advanced plays, right? So let's get into Section 3, the exception to the rule. This is for those really big long-term projects. And that's where we meet something called a qualifying asset. Now, this isn't the stuff you sell every day. We're talking about the huge projects, the ones that take a really long time. We're talking over a year to get up and running. Think building a massive new manufacturing plant or a power station. And here's why that matters. For a normal deal, like the one we just saw, any currency gain or loss goes straight to your profit or loss statement. It hits your bottom line right now. But for these huge qualifying assets, it's different. Those same currency fluctuations get added into the cost of the asset itself. They get capitalized, which kind of makes sense, right? It bundles all the real costs of building that huge thing together. So that Australian company, they got lucky. But what if the currency had gone the other way? Their debt could have ballooned. And that brings us to the solution. Section 4, hedging. This is your financial shield. Let's be real. That $36,000 gain was pure luck. It could have just as easily been a massive loss. And if there's one thing businesses absolutely cannot stand, it's uncertainty. You can't build a global company by just crossing your fingers and hoping the currency market is nice to you.
So, what is hedging? Well, the official definition says it's an action you take specifically to avoid or lessen the bad things that can happen when exchange rates move around. It's a proactive defense. But honestly, the best way to think about it is this. Hedging is just like buying insurance for your currency. That's it. You pay a small, predictable premium upfront to protect yourself from a potentially devastating, unpredictable disaster later on. You're swapping a giant risk for a small, manageable cost.
So how does it actually work? Well, it's a three-step dance. First, you identify your risk, that 200,000-pound payment you have to make later. Second, you go to a bank and enter a separate contract to lock in an exchange rate for the future. That's the hedge. And third, this is the magic. The two are designed to cancel each other out. If you lose money on the original deal because the rate went against you, you make money on your hedge contract. One offsets the other.
And at the end of the day, that's the whole point. The goal of hedging is not to gamble and make more money. It's the exact opposite. It's to take the wild, unpredictable chaos of the currency market and turn it into a boring, stable, predictable business cost. It's all about creating certainty.
Which leaves us with a pretty interesting question to chew on. If these tools are so good and companies can theoretically hedge away all of this risk, does that mean doing business globally isn't a gamble anymore? Or have they just shifted that risk to someone else? Something to think about.